What is the next asset that is going to come into picture? It is the quick ratio. What is this quick ratio? You take the current assets, reduce it by the inventory. That is, you will be holding some inventory, divided by the current liabilities. It gives you the quick ratio. What does this quick ratio give you? It gives you the firm's ability to pay off short-term obligations without relying on the sale of inventories. So there is an inventory with you. Without having to bother on the sale of this particular inventory, you can still service the current assets that you have taken. The last ratio is inventory to net working capital. How do you calculate this inventory to net working capital? It is inventory divided by current assets minus current liabilities. What does this give you? It gives you a measure of the extent to which the firm's working capital is tied up in inventory. In other words, as I mentioned throughout this particular lecture, you don't produce normally to stock, you produce to sell. That is, your inventory holding should be minimum as far as possible. So this is what most of these leading car companies like the Toyota or the Honda follow. They don't want to produce to stock, they would like to sell off. So keep minimum inventory. So many times when you book a Toyota car, he will tell you the waiting time is about 2 months or 3 months, depending on the model that you are choosing. Similarly, with respect to a Honda City car, if you book it, he is not going to deliver the Honda City car in 1 day or 2 days. Further, this gets more complicated depending on the color that you want for the car. So that particular color may not be available in stock. He will say, sir, it takes 6 to 8 weeks or 4 to 6 weeks or 3 to 5 weeks, depending on the type of inventory which this particular organization holds. So this is normally the way organizations try to reduce inventory, because if you reduce inventory, what is going to happen? You will have a better working capital management. So you need not keep on borrowing funds to service your working capital. It becomes a chain reaction. You pay interest on the working capital loan and you produce something that whatever you are producing is not selling in the market. So again your inventory holding cost goes up. Your interest on the working capital also keeps growing. All this impinges on the health of the organization. So in other words, what are we trying to say in the whole process? The market forces make a high dent on a company's operatable profits or operating scenarios. So these market forces keep on changing. That is what is called the business landscape with respect to an organization keeps on changing. This is called the dynamics of business environment. And in an organization, there is always a team to look at these dynamics. Keep on observing what is happening to the market in which the company is operating. So their job is from the morning to the evening is to keep on looking at how the business environment is changing. All this was given by a wonderful Indian who is now no more, by name Soumitra Ghoshal, who did this wonderful business landscape analysis. He was from the London School of Business. So he gave how to map this business environment with respect to an organization. How do you map it? So much on this liquidity ratios. So with respect to any organization, you have to look at these 4 ratios. One is the profitability ratios. Second is the leverage ratios. Third is the liquidity ratios. Fourth is the activity ratios. These 4 ratios you must and should look at. In addition, you can also look at a few more ratios. What are these ratios? These are called other ratios. What are these other ratios? These other ratios refer to dividend yield on common stock, price earnings ratio, dividend payout ratio, and the cash flow per share. So there are 4 ratios which you normally look at other than these four types of ratios which I mentioned. These are with respect to dividend yield on common stock. In other words, what is this dividend yield trying to tell you? How much dividend you got on your common stock. That is, suppose you put 10 rupees in the share of the company. You got a dividend of 2 rupees. Let us say, what does it tell you? Your 10 rupees investment into this organization has produced 20% return. Now, this is many times the questions which you yourself will ask. Suppose somebody wants from you money to set up a business. You will always ask, how much return am I going to get by investing in your business? Suppose he says that you can expect an 8% return. You normally start thinking a business has its ups and downs. In other words, a business always has a risky proposition associated with it. Now, suppose I keep my money in the bank in a fixed deposit. Without taking much risk, I can get this 8% return. Why should I invest in this business? And suppose in a particular year, this business is not performing well, then this 8% return will also not come. It may be much less than 8%. So these are the types of scenarios a business investor would be looking at. He will always look at why I should invest in this business. What is the type of return which I am going to get? The second ratio that you are looking at is called the price earnings ratio. What is this price earnings? Normally, a share of 10 rupees, when you are looking at with respect to the stock market, it gives you a much higher this thing. That is, you many times start wondering with respect to an organization, by how much is my share growing? Is the 10 rupees share at 10 rupees only, or is it 20 rupees or 30 rupees? In other words, this current market price per share divided by the after-tax earnings per share gives you the price earnings ratio. It tells you the faster growing or less risky firms tend to have higher prices earning ratios than do slower growing or more risky firms. So as an investor, you might like to put your money in a less risky firm rather than a high risk firm. A dividend payout ratio tells how much of the percentage of profits is paid out by the company as dividends. A company might like to keep a certain amount of money in its reserves. Why does it keep it in reserves? It may be to ward off an undesirable situation with respect to the company where its cash is coming under serious threat. That is, if an organization does not have cash, then again you go in for borrowing. Suppose you develop a good healthy reserves, you don't have to go in for borrowing. So take the example of Infosys. Its cash reserve position is in such a healthy state that even when it wants to acquire any other company, it can do so from its own reserves. It doesn't have to borrow. Similar is the situation with respect to many Tata companies as well. So this dividend payout ratio, in a sense, tells you how much of the profit after tax is paid out as dividend and how much is going back to these reserves. Then what is the fourth ratio that you are looking at? The fourth ratio is what is called the cash flow per share. What is this cash flow per share going to give you? It is a measure of the discretionary funds over and above expenses available to the firm. In a way, it is also again pointing out to the type of reserves only. So, dividend payout ratio, cash flow per share gives you an indication of how much reserves an organization is keeping to ward off threats as and when it perceives. So, how do you calculate this cash flow per share? It is calculated by after-tax profits plus the depreciation divided by the number of common shares outstanding. All these formulae which I have just listed, I have uploaded this in a PDF. This is also available to you in my case studies book. Kindly go through these PDF material. It will be very helpful for you to analyze an organization using these ratios. It will make you become a more informed person. What do you mean by saying you become a more informed person? You are not just talking through thin air. You are talking with facts and figures with respect to the organization. And when you are talking with facts and figures with respect to the organization, you are a much better informed person rather than a person who is talking through his hat, saying, oh, this company is not good. Why do you say the company is not good? What is it that you have in your weapons armory to categorize this company as bad? Suppose this question were to be asked to him and he is not able to answer, then it becomes a question mark. At the same breath, you are able to say, prove the point why this organization is going through troubled times and hence presents a risky investment through your facts and figures. Then you are in a better position to convince the investor. Okay. So in other words, all these ratios will help you to analyze an organization much better, and your case analysis should cover to the extent possible and to the extent relevant these ratios. That is, you must calculate these ratios with respect to the organization. So we will stop here. We will continue in the next lecture, the marketing environment. Thank you.